All right, let's dive right into Bank OZK's latest earnings call. This one was a real head scratcher. You had management telling this story of record breaking success, but at the same time, the market was, well, it was skeptical to say the least. It's a classic case of management seeing one thing and Wall Street seeing something completely different. So let's peel back the layers and figure out what's really going on behind the numbers.
So here's the central conflict right here. On one side, you've got the CEO, George Gleason, listing off record after record, record net income, record EPS. You get the picture. But then you look at the other side, and what happens? The stock drops. So what gives? This is the paradox we're going to unpack. It all comes down to what the market is actually worried about versus what management wants everyone to focus on.
Okay, let's look at the headline numbers. Revenue actually came in a little bit better than expected, which is great. But the market's eyes immediately went to the bottom line, the EPS. And you can see it right there, a miss, a 7-cent miss. Now you might think, 7 cents, what's the big deal? But in the world of Wall Street expectations, that kind of miss is a huge signal. That single number is really our first big clue as to why the market got so spooked. So, naturally, that EPS miss immediately put the bank's loan book right under the microscope. And for a bank like OZK, which is so heavily involved in commercial real estate, or CRE, asset quality is, it's everything. It's the name of the game. So, what did we find when we looked closer? Well, it's a complicated picture, a real mixed bag. Okay, these are the red flags that really got the market worried. We saw 3 big credit migrations, which is just a fancy way of saying loans went from okay to not so okay. That led to charge-offs, which is when the bank basically has to admit, all right, we're not getting this money back, and they write it off as a loss. Now, this wasn't a total surprise, but seeing these potential problems become actual concrete losses, yeah, that was definitely enough to put investors on edge. But it's not all doom and gloom. This is the other side of the coin. Management showed that, hey, they know how to handle these problem assets. They sold off their biggest foreclosed property, what they call an Oreo in the biz, at book value, meaning they didn't lose any money on it. Huge win. And they even got sponsors to put up an extra $70 million in reserves for other loans. So what's the big takeaway here? It's that even when a loan goes south, Bank OZK's process for cleaning up the mess is absolutely rock solid. And, you almost have to appreciate the honesty here. Who better to sum it all up than the CEO himself? He comes right out and says, yeah, it was a mixed bag on asset quality. He's not trying to sugarcoat it or spin some wild story. To me, that's a pretty powerful signal. It says we see the problems, we're not hiding from them, and we're dealing with them head on. Right, so this whole mixed bag thing, it's not just a blip on the radar for one quarter. This is a long-term concern for anyone watching the stock. So the big question is, what's the bank doing about it? How are they addressing these worries about their big bet on commercial real estate? Well, they're making a huge strategic pivot, one designed to de-risk the whole business and find new ways to grow. For years, Bank OZK has been all about their Real Estate Specialties Group, the RESG. That's been their bread and butter, their growth engine. It's made up a huge chunk of their loan book. But the future? Well, the future looks totally different. The plan is to seriously beef up their commercial and institutional banking division, or CIB. The goal is to get CIB up to almost 40% of the total loans. We're talking about a fundamental shift toward a much more balanced and diversified bank. So why make this big pivot? Well, this isn't just about playing defense. It's actually a really smart offensive move. First, and most obviously, it diversifies risk away from that cyclical CRE market. Second, it opens up whole new ways to make money, things like fees for treasury services, and critically, it brings in low-cost deposits. And third, the timing is just perfect. They're ramping up this new CIB engine right as a big wave of their old real estate loans is set to mature and pay off. It's a really well thought out strategy. Okay, so credit quality is one piece of the puzzle, but there's another big headwind we need to talk about: interest rates. The Fed has been cutting rates, and every investor is asking the same exact question. What is this going to do to the bank's core profitability, its net interest margin, or NIM? The best way to think about this is a timing mismatch. When the Fed cuts rates, the income the bank makes from its loans, that reprices lower almost instantly. Boom, it's done. But the money they pay for their funding, a lot of which is tied up in CDs, well, that's a much slower moving train. Those rates are locked in for months. So you get this painful lag, maybe for a couple of quarters, where their profit margin gets squeezed pretty hard while they wait for their funding costs to catch up. But here's the ace up their sleeve: loan floors.
Think of these as a safety net built into their loans. They basically say, hey, the interest rate on this loan can't drop below this specific point, period. And this is a huge deal. As this chart shows, with just one more rate cut from the Fed, more than a third of their variable rate loans will hit that floor. That's going to put a brake on the falling income and provide a really powerful cushion to stabilize their margins way faster than a lot of people on the street are expecting.
All right, we've looked at the record results versus the red flags, we've unpacked the big strategic pivot, and we've dug into the mechanics of their profit margins. So now it's time to put it all together. What's our verdict here at Talk Tickers? What's the call on Bank OZK? And really, this is the fundamental question for any investor looking at this stock, right? Do you get bogged down by the short-term noise, the margin pressure, the credit issues, or do you buy into the long-term story and bet on this big strategic shift paying off?
So here it is. Our official verdict is market perform. Look, the short-term pressure on their margins is real, and we think that's going to keep the stock pretty much range-bound for a while. You could say the bank is in a prove-it moment. Wall Street is watching and waiting. They need to see that the CIB growth story is more than just a plan on a slide deck. It needs to deliver real results to offset that wave of REIS payoffs. And management is being pretty clear about the timeline here. They're essentially telling us to expect 2026 to be another transition year. You know, some growth, maybe some records, but nothing spectacular. But 2027? That's the year they're circling on the calendar. That's when they expect to really hit the gas and see much more meaningful growth. And that, right there, is the potential catalyst that long-term investors are looking for.
So there you have it. That's our breakdown of Bank OZK's quarter. It's a really fascinating story, isn't it? A tale of record results on one hand and some serious red flags on the other, all happening while the bank is trying to pull off a massive strategic pivot. And just as a reminder, this is not financial advice.